So this is ChargePoint on the monthly chart, and to get a better picture of that trend line, we're going to go right to the weekly chart, and you can see how price hit it once, twice, three times, had a false breakout to the downside, then you had another break to the downside. Typically when you break a trend line, you do retrace and test it before the continuation in that direction, and that's what we see in the past couple of weeks. Price is trading at $5.09. They say don't catch a falling knife, but one analyst on Wall Street thinks that ChargePoint still has a lot of potential. Let's get into the article, and then we'll get back into the analysis. So this article is coming from Investor's Place. And again, one of the best ways to play the red hot EV market may be through the derivative companies, a la ChargePoint. While individual automakers see demand rise and fall, the need for EV charging infrastructure is only going to increase. Now, Wall Street analyst by the name of TD Cowen has flagged ChargePoint as a particular leader in this space and a likely winner of the EV boom. Right now we have an EV bust, but it will be an EV boom again at some point in the future as adoption continues to grow. ChargePoint stock is still recovering from a difficult start to the year. Shares are down significantly for the past 6 months, but TD Cowen is focused on the future, and it believes ChargePoint is on track towards a highly profitable one. TD Cowen analysts have conducted a detailed analysis with a definitive conclusion that the amount of EVs in the US is expanding rapidly, really worldwide. As a result, the number of public charging ports in the US must grow to 1.7 million by 2030 to keep pace with the growing EV fleet. According to their findings, this type of massive and rapid expansion would require a government investment of $104 billion. While ChargePoint isn't the only EV charging stock, it is the firm that TD Cowen sees as having the most growth potential. The firm maintains a highly bullish price target of $10 on the stock and an outperform rating. So that says that the stock could go up pretty much 100% from current prices at, say, $5. They go on to say, minimum capex is required in the ChargePoint business model, as the company relies on its commercial, hospitality, parking, fleet, and other customers to effectively crowdfund the build-out of EV charging infrastructure. This capital-light plan also attaches software to every charging station sold with a nearly 100% attach rate, offering the company strong visibility into recurring revenue streams. Now here's the part that I didn't realize, which is pretty clever, and you can see that happening in the software space, this subscription model. TD Cowen cites ChargePoint's high quality hardware and subscription based business model as key reasons for its bullish stance on the company. The firm isn't the only one who sees ChargePoint stock as a winner either. A consensus of 13 Wall Street analysts rate shares as a strong buy. Now, kind of going back to the charts here. And we can see that earnings met expectations, exceeded expectations until this past quarter, where expectations on earnings weren't met. Kind of looking at their revenue, you can see the revenue has been growing. However, their profit margins have been declining. And again, over the past year, the stock is down 68%. Past 3 months, 32%. Past month, 28%. Past week, 12%. So, I would say, do not catch the falling knife. Although it's very favorable on Wall Street, I would wait for some type of reversal pattern, maybe a double bottom, maybe a W reversal bullish pattern, Right now, price can definitely go lower, and you know, there's no rush to get in at this point. Thanks for watching. Subscribe. Please like the video.